The same firm that audits your company's books to ensure they follow tax law also sells that company's strategies to avoid paying taxes. The same accountants who certify financial statements are accurate and legal, design structures specifically to make profits disappear from taxation. The same professionals who sign off that everything complies with regulations profit when those regulations are circumvented. This isn't corruption in the traditional sense. This is the business model. Legal, accepted, celebrated, the big four accounting firms. Deloitte, PricewaterhouseCoopers, Andersen, Young, KPMG generate over $150 billion annually by serving two masters simultaneously. They audit companies to verify honesty, and they consult for those same companies on how to legally deceive tax authorities. The conflict of interest is total, absolute, and completely permitted by law. In 2014, a leak changed everything, or should have. An anonymous whistleblower delivered 40,000 pages of documents to a journalist in Luxembourg. Tax rulings, secret agreements between the Luxembourg government and multinational corporations, all facilitated by one firm, PricewaterhouseCoopers. The documents revealed 340 companies had negotiated private tax deals, arrangements that let them route profits through Luxembourg while paying effective rates below 1%. Below 1, Apple, Amazon, FedEx, IKEA, Pepsi, Disney, hundreds of the world's largest corporations, all using identical structures, all designed by the same accountants, all approved in private meetings between PwC and Luxembourg tax officials. The LuxLeaks scandal exposed what everyone suspected but couldn't prove. The Big Four don't just help companies comply with tax law. They help them escape it legally, systematically, profitably. This investigation analyzes the LuxLeaks documents from 2014, UK Parliament investigations from 2080, and United States Justice Department settlements. All sources are cited in the description below. The Big Four weren't always oligopolies selling tax avoidance. They started as partnerships of accountants in the late 1800s. Local firms serving local businesses, verifying ledgers, counting inventory, simple services for simple clients. But as corporations grew, as they expanded internationally, as their finances became complex, these accounting firms grew with them, merged, consolidated. By the 1980s, there were 8 major firms, the Big 8. They competed for audit contracts, for consulting engagements, for the privilege of examining corporate books and certifying accuracy to investors and regulators. It was prestigious work. Professional, trusted, but then something shifted. Corporations wanted more than audits. They wanted advice, tax advice, how to structure transactions to minimize liability, how to interpret regulations favorably, how to use offshore subsidiaries legally. And the accounting firms realized they could provide this. They had the expertise, understood tax code intimately, had relationships with regulators, could design strategies that walk the line between legal planning and aggressive avoidance. So they created consulting divisions, separate from audit teams technically, but part of the same firm, selling to the same clients, and the revenue from consulting soon dwarfed audit fees. By the 1990s, the Big 8 had become the Big 6 through mergers, and their business model had transformed. They were no longer just accountants verifying numbers. They were architects of tax avoidance, selling structures, marketing schemes, competing to offer the most aggressive strategies to minimize corporate taxes. The conflict was obvious. How can you audit a company, honestly, when that company pays you millions for consulting? How can you certify their tax practices comply with law when you design those practices specifically to exploit legal gaps? How can you serve shareholders and regulators when your income depends on keeping corporate clients happy? The answer is you can't, not with integrity, but you can do it legally because the rules permit it, actually encourage it. The same regulations that require public companies to have independent audits allow those auditors to also consult, to sell advice, to profit from the very companies they're supposed to objectively examine. And then Enron collapsed in 2001. The energy company had used accounting fraud to hide billions in debt, created fake entities, manipulated earnings, lied to investors, and their auditor, Artug Andersen, one of the big five at the time, had signed off on everything, certified the financials were accurate, approved the structures, took millions in audit and consulting fees while the company committed fraud. When Enron imploded, Arthur Andersen was convicted of obstruction of justice for shredding documents. The firm collapsed, dissolved, 85,000 employees lost jobs, and the Big Five became the Big Four: Deloitte, PwC, Ernst & Young, KPMG, for firms that now audit 99% of Fortune 500 companies, for firms that dominate completely, for firms that learn nothing from Enron except to be more careful to create better legal protections, to structure consulting arms with more plausible separation from audit teams. The conflict remained. The business model continued, only the risk management improved. Congress passed Sarbanes-Oxley in 2002, supposed to fix everything, required auditor independence, restricted certain consulting services, created oversight boards, increased penalties for fraud, but it changed almost nothing fundamental because the Big Four lobbied extensively, watered down provisions, created exceptions, ensured they could still consult on tax strategy, still design offshore structures, still profit from the same clients they audit. The law looked tough, sounded comprehensive, and preserved the exact conflict that enabled Enron, because the people writing the regulations, many were former Big Four partners. The people enforcing them, many would join the Big Four later. The revolving door ensured the rules would protect the industry, not the public. If you're starting to see that the entire system is designed by insiders, for insiders ... that the accountants who should ensure honesty are incentivized to enable deception, then you need to understand the scale. Subscribe now, because what comes next shows exactly how the Big Four sell tax avoidance as a product, how they market schemes, how they profit from complexity, and why your taxes are higher because corporations pay less. The LuxLeaks documents revealed the precise mechanism. A corporation would approach PwC in Luxembourg. Say they had European operations generating billions in profit. Didn't want to pay standard corporate tax rates of 25 or 30%. PwC would design a structure, create a Luxembourg subsidiary, have that entity own intellectual property or provide intracompany services. The operating companies in high-tax countries like France or Germany would pay enormous fees to the Luxembourg entity. Licensing fees, management fees, enough to eliminate most profit in the high-tax jurisdictions. The money flowed to Luxembourg. Luxembourg had negotiated a private tax ruling, an agreement that this specific structure would be taxed at a rate negotiated privately, often below 1%, sometimes below 0.1. The profits appeared in Luxembourg, got taxed at almost nothing, then moved to another offshore jurisdiction, or stayed in Luxembourg accumulating. The corporation paid a fraction of normal rates. Luxembourg collected some revenue, and PwC charged millions in fees for designing and implementing the structure. This wasn't one company. The leaked documents showed 340 separate tax rulings, 340 companies using variations of the same scheme, all facilitated by PwC. The firm had effectively industrialized tax avoidance, created templates, standard procedures, could set up these structures efficiently, market them to clients, promise specific tax savings, charge based on a percentage of taxes avoided. It was a product, a service, sold like consulting on any other business problem, except the problem was paying your legal obligation, and the solution was making that obligation disappear. Amazon used Luxembourg structures to root billions in European profits, paid minimal taxes for over a decade while competitors paid standard rates. FedEx did it, Disney, Pepsi, IKEA, companies you use, brands you trust, all buying the same service from the same firm. PwC earned hundreds of millions in fees from these arrangements, and simultaneously, PwC audited many of these companies, certified their financial statements, vouched for their tax practices to regulators and shareholders. The same people designing the avoidance were certifying it was legal and proper, investigating themselves, approving their own work, and calling it independence. When the LuxLeaks story broke in November 2014, there was outrage. European Parliament launched investigations. Luxembourg's government changed. The European Commission opened state aid inquiries. Media covered it extensively. Activists demanded reform, and nothing happened. A few tax rulings were challenged. Some companies paid modest fines. Luxembourg tightened procedures slightly. But PwC, they were never prosecuted, never lost major clients, barely apologized, because what they did was legal. Luxembourg law permitted private tax rulings. PwC was hired to navigate that law. They navigated it aggressively, but legally. The structure exploited gaps between national tax systems, gaps that every government knew existed, gaps that accountants were professionally hired to find and use. You can't prosecute someone for doing exactly what their client paid them to do. Using tools the law provides, Deloitte operates the same way, specializes in transfer pricing, the art of setting prices for transactions between subsidiaries of the same company. If your German factory sells products to your Irish sales company, what price should they use? Market rate, cost plus a margin, whatever minimizes taxes. Deloitte advises on this, creates economic justifications for prices that shift profits to low-tax jurisdictions, defends those prices to tax authorities, and charges millions for their expertise. They also audit companies, certify the transfer pricing is reasonable, that the financial statements reflect reality. How can they do both? Because both are legal, permitted, expected. Ernst & Young pioneered offshoring intellectual property, helped tech companies move patents and trademarks to Irish or Dutch subsidiaries, create licensing arrangements where operating companies pay fees to use their own company's IP. The fees eliminate profit in high-tax countries, accumulate in low-tax havens. EY designs this, implements it, defends it during audits by tax authorities, and also audits these same companies, signs off that everything is proper, legal, accurate. KPMG got caught in 2005 selling illegal tax shelters in the United States, marketed schemes that had no economic purpose except avoiding taxes. The Justice Department prosecuted KPMG, paid $450 million in fines, admitted wrongdoing, agreed to estoppel, and kept doing variations of the same thing, just more carefully, more documentation, better legal opinions. They learned to stay on the legal side of the line. Barely the business model didn't change. The risk management improved. What's astonishing is the scale. The Big Four collectively generate over $150 billion in revenue annually. Roughly 40% comes from tax and consulting services. $60 billion per year from helping corporations and wealthy individuals minimize taxes. That's $60 billion in fees charged for strategies that reduce government revenue by trillions. The math is devastating. For every dollar the Big Four earn helping clients avoid taxes, governments lose perhaps $50 in revenue. Revenue that should fund healthcare, education, infrastructure. Instead, it stays in corporate accounts or moves to offshore subsidiaries. And the accountants who enable this, they're celebrated, wealthy, respected. Partners at Big Four firms are millionaires. Senior partners make tens of millions from a business model built on helping clients avoid obligations while auditing those same clients while certifying they're compliant. The contradiction is complete. But here's what they don't tell you. What gets obscured by complexity and legality? The Big Four aren't neutral advisors. They're advocates. They lobby governments to create loopholes, draft favorable legislation, testify that proposed reforms will harm competitiveness. Then they sell strategies exploiting the very loopholes they helped create, and they rotate personnel. Partners leave to join government, write regulations, then return to the Big Four to advise clients on those regulations. Treasury officials join PwC. Tax court judges retire to the revolving door ensures the rules stay favorable, the gaps stay open, the business continues. And when scandals emerge, when leaks expose the mechanisms, when investigators demand accountability, the Big Four respond identically. They say everything was legal, that they follow professional standards, that clients have a right to minimize taxes within the law, that they're just doing their jobs. And legally, they're correct. Professionally, they're protected. Ethically, they're bankrupt. But ethics aren't enforceable. Only law matters. And the law was written to permit exactly this. Do you see the impossibility of reform? How can you regulate firms that help write the regulations? How can you oversee auditors when the overseers are former auditors? How can you stop tax avoidance when the people designing it are the same people certifying it as legal? The system protects itself through complexity, through legal technicalities, through revolving doors between government and industry. The Big Four aren't breaking rules. They're operating a business model where the rules were designed to enable their business, where a conflict of interest is baked into law, where independence is fiction, where oversight is theater. If this has shown you that the accountants verifying corporate honesty are the same people selling corporations ways to deceive, if you're understanding that the Big Four profit by serving two masters simultaneously, if you see that, reform is impossible because reformers become consultants, then you need to know what we're revealing next. Subscribe now, because the next investigation exposes the rating agencies, how Moody's and S&P sold AAA ratings to junk mortgages, how they were paid by the companies they rated, how that conflict destroyed the global economy in 2008. The same pattern, the same corruption, the same legal protection, and nobody went to prison. The Big Four defend their model aggressively. They say audit and consulting are separated different teams, different partners, Chinese walls between divisions, but it's the same firm. The audit partner wants the client happy because unhappy clients fire auditors, and the consulting division is pitching those clients on tax strategies. If the auditor is too strict, questions too aggressively, challenges structures too hard, the client might leave, take their audit fees and their consulting fees. The pressure is subtle, unstated, but total. Be cooperative, be flexible, interpret rules favorably, because if you don't, single quotes T ... competitors will. KPMG will be more accommodating than Deloitte. EY will be friendlier than P. The race to the bottom is built into the oligopoly structure. For firms competing for the same clients, offering the same services, differentiated only by how aggressive they're willing to be, how much they'll justify, how creative they'll get with interpretations. And corporations know this, play firms against each other, threaten to switch auditors if opinions are unfavorable, demand consulting proposals from multiple firms, choose the one offering the most tax savings, the most aggressive structures, the best legal opinions defending questionable positions. It's a market, supply and demand. The Big Four supply, compliance, and avoidance simultaneously. Corporations demand both, and the market delivers. But here's the cost. When corporations pay minimal taxes through Big Four design structures, governments need revenue. They can't cut spending proportionally, can't eliminate defense or healthcare or social security, so they raise taxes elsewhere on individuals, on small businesses that can't afford big for accountants, on labor instead of capital. The burden shifts from those who can hire sophisticated advisors to those who can't, from multinational corporations to local companies, from the wealthy to everyone else, and the Big Four profit from both sides. Help corporations avoid, help governments understand what corporations are doing, consult for tax authorities trying to catch what consultants designed for taxpayers. It's perfect. Total capture. They're embedded in every aspect of the system. Indispensable, untouchable. The numbers are staggering. Academic research estimates corporate tax avoidance costs governments globally over $500 billion annually, $500 billion every year. Much of it facilitated by Big Four design structures, and the firms earn perhaps $60 billion in fees for this work, a 12-to-1 return. For every dollar they make, governments lose 8. Society loses infrastructure, services, investment. The wealth doesn't disappear. It accumulates for shareholders, for executives, for offshore accounts, but it's extracted from the public good, privatized, made invisible. And the accountants who enable this, they're prestigious, hired the best graduates, offer prestigious careers, wear expensive suits and work in towers. The legitimacy is complete. The corruption is invisible because it's legal. What would you do if you realized the people certifying your company follows rules are the same people teaching it to break them? Would you trust an auditor who profits when clients avoid obligations? Would you believe financial statements certified by firms that design the questions answered themselves? But we accept this, normalize it, call it business, call it professional services, call it advisory. When it's extraction, when it's corruption by another name, when it's a conflict so total that independence is impossible, but we pretend. Because questioning it threatens the entire structure. If Big Four audits aren't trustworthy, then financial markets aren't reliable. If you can't believe certified statements, then investing is gambling. The whole edifice depends on maintaining the fiction that auditors are independent, that accountants serve the public interest, that professionals police themselves. None of it is true, but admitting that collapses trust, destroys markets, forces fundamental reform. So we don't admit it. We pretend. We comply. We accept. The Big Four have created a world where complexity is profitable, where understanding is expensive, where the rules are so intricate that only specialists can navigate them. And those specialists work for the highest bidder, not for truth, not for fairness, not for society, for clients who pay millions, who demand results, who measure success in taxes avoided, and the accountants deliver, design structures, create entities, root profits, make billions disappear, then certify it's all legal, audit themselves, approve their own work, and bill for both services. The circle is complete, perfect, unbreakable, but it's collapsing slowly, invisibly, because mathematics doesn't care about legality. When corporations pay nothing, governments accumulate debt. When debt becomes unsustainable, currencies collapse. When currencies collapse, the wealth accumulated offshore becomes worthless. The Big Four are building a system that will eventually destroy the value they're helping clients preserve. But that's long-term, years away, maybe decades. And in the short term, this year, this quarter, the fees are enormous. The clients are happy. The partners are wealthy. Why would they stop? Why would they reform? Why would they sacrifice profitable business today to prevent collapse tomorrow? They won't. They can't. The incentives don't permit it. The structure doesn't allow it. The system is designed to extract until extraction becomes impossible, until there's nothing left, until it all breaks. And when it breaks, when governments default, when currencies when the public realizes they've been funding corporate profits through higher individual taxes, the Big Four will still be fine. They have offshore accounts to diversified assets, multiple citizenships probably, partners who can leave, relocate, start over. The people who built this system, they're protected from its collapse. Your taxes are higher because corporations pay less. Your services are cut because governments need revenue. Your future is mortgaged because debts accumulate. And the accountants who designed this, they're collecting fees, building wealth, preparing exits while you pay, comply, trust, accept. The Big Four scandal isn't that they broke laws. It's that they didn't have to. The system is designed to make their business model legal, to permit conflicts of interest, to allow serving two masters, to enable profiting from complexity they create. They're not criminals. They're professionals operating legally, following rules, making billions by helping clients avoid contributing to society, while certifying those clients are honest. The contradiction isn't it's the feature. It's the business model. It's how modern capitalism works in its final corrupted form. Wake up. See the structure. Calculate the cost. The Big Four makes $60 billion annually helping corporations avoid $500 billion in taxes. You pay more because they pay less. Your services are cut because revenue disappears. Your future is sold because they need clients happy. And the accountants who enable this, they audit it. Certify it, vouch for it, profit from both sides. The conflict is total. The capture is complete. The future is extraction until collapse. And they absolutely know. They just don't care. Because carrying costs, fees are everything.